Chetan Ahya is with us, who's the Chief Economist and Global Head of Economics at Morgan Stanley. Chetan, it's great to have you.
My pleasure.
It's great that we're kickstarting the investor conference with getting a global picture from you, especially on what's happening with global economics at this point in time. So the opening question is the U.S. economy on firm footing? And are the numbers only going to look stronger, which makes the Fed's job a little harder? So what do you think?
Yeah, no, absolutely. I think we were of the view that 1Q data softness was really more residual seasonality and some aspects related to weather. But second quarter looks pretty strong. We are now tracking second quarter at 3.9% in our model, which is also something similar that Atlanta Fed is indicating. So yeah, we have started on a very strong note in 2Q already in the US.
So is this good news, bad news for others?
In some ways, yes, because if the Fed is looking at this data, the Fed will feel more confident that it should take up rates higher and it should continue to unwind the balance sheet. So in some ways for emerging markets, it will get tougher. But look, it's bad for emerging markets who don't have their house in order. If you have your house in order, the fact that the US is good should help global trade and global exports and EM's exports. And so it should be fine. Remember in 2003 to 7, the Fed kept hiking, but EMs were fine, because their starting point was in a much better position in terms of macro stability, and they could hike interest rates because those interest rate hikes were counter-cyclical rather than pro-cyclical. So I think as long as EMs, and so there's a case for differentiation in EM this time. I think because it is not as good as 2003 for all EMs, some EMs are in a bad shape, like Argentina, Turkey, have a macro stability problem, and those are the guys which will have challenges. But countries like India should be absolutely fine because we are having a much better starting point in macro stability indicators.
You know, every time we see a sell-off in emerging market currencies, historians, they tend to draw parallels. And the parallel which everybody seems to be drawing, at least the naysayers are drawing, is that there could be a repeat of 2013. Fed is going to increase rates. Emerging market currencies would remain vague because of structural issues and cyclical issues, and we may see more pain in terms of financial adjustment and more risk of trade.
So look, I think the way we approach it is we look at the starting point of EMs in two major policy focus approach. First is what is the overall policy mix, which is fiscal policy, monetary policy, and labor market policy. Remember in 2013, if you just take India's example, fiscal deficit was very high. Yeah. Right, you had real interest rates at 200 basis points negative, and current account deficit was 5%. So if you have bad fiscal, monetary policy, and labor market policy, you will have higher inflation and current account deficit. So that's the second set of things we watch. What are the macro stability indicators showing as an outcome of this policy mix? And right now, bulk of the major emerging markets, Argentina and Turkey are exception. Bulk of the major emerging markets have good policy mix and therefore have very good macro stability indicator position. Current account deficit is back to 2009-10 levels, and inflation is even lower than what it was in 2009-10. So they're in a much better position. We think EMs will be able to withstand this rise in US interest rates.
No, but do you think the rise in the US interest rates will happen faster than expected? I mean, so this year you're looking at one more in June and then December. That's the baseline. Do you think with momentum picking up on growth and with what's happening in the oil market, if there's concern coming in on inflation as well, that they could hike in September too, which would be a surprise, which would be perhaps giving the market a sense that we are confident to go faster?
So look, market's already moving towards pricing in 3 more. We are at this point of time building in 2 more rate hikes because we think that the Fed will probably need to take a bit of a pause, watch for the fact that they would have taken real interest rates closer to neutral by taking up 2 more rate hikes. And our rate hikes are, by the way, in June and September.
Okay.
And so we are saying that the Fed will skip in December quarter because they need to watch on the fact that real interest rates would have reached closer to neutral.
Okay.
So we want to take a pause and evaluate the case further. And also at the same time, the balance sheet unwind will still continue to happen. And they would also want to take a stock on the impact of that balance sheet unwind and then resume back in early next year, because we think the economy will be holding up fine, and that will give the Fed to confidence to go back into the rate hike path from next year. And then we expect 3 more rate hikes in 2019.
So we've seen that in past cycles, the US generally leads the world through a rate tightening cycle. It's happened in 2006 as well. Do you think that would perhaps influence emerging market central banks as well? We have a credit policy coming up. Do you think even though the RBI has not indicated in as many words they're going to hike rates, but is that the direction that EMs will take eventually, perhaps over the course of the next 6 months, where a lot of EMs will hike rates?
Yeah, we are expecting most EMs to hike rates, including those in Asia. But we think bulk of the rate hike that EMs will take up this time will be counter-cyclical. Because they are already seeing a big pickup in growth. India's capex cycle is still somewhat lagged, but all the other emerging markets have already seen a big pickup in capex in the last 3 quarters. Okay. So it makes sense for those central banks to hike interest rates. It would be actually warranted by domestic growth and inflation fundamentals, rather than them being forced by the Fed like it was in 2013. So that's the other difference, you know, Nikunj, when you were asking earlier. In 2013, they had a bad starting point. Okay. They were forced to hike interest rates, and those interest rate hikes were pro-cyclical. Whereas these interest rate hike will be counter-cyclical. So,
do you think crude and trade fear, these are two things which could genuinely spoil the party? Because when we started the year, the general view was crude is not going to go to $50 plus. We are at $75. Trade war, yes and no, but now we can argue whether it is real or whether it is just posturing.
So I think let's address two issues separately. On oil, the way to address this issue from EM's perspective or global economy's perspective is to ask whether this rise in oil prices is supply driven or demand driven. If it is demand driven, then the question is whether this is at a level in terms of oil burden which is high. And so when you address it on both these points, firstly, it is demand driven. If you plot crude oil prices year on year versus global industrial production trend, it's a 1-to-1 link. See, the petrol part of it, the gasoline part of the demand and demand for oil is relatively steady. The one which fluctuates is diesel, and that's very strongly correlated with industrial production. So we think this rise in oil prices is driven by demand, and in some ways it's therefore endogenous to this recovery cycle, and it shouldn't cause a big problem to the global growth and for that matter EM growth cycle. The case in point is 2003 to 7. That's exactly what happened. 2003 oil prices were closer to 20 and they kept going up to 100. India's current account balance was around 1.5–2% of GDP all through, until the last leg when oil prices ran up very quickly in a short span by about $50. And inflation was also fine right until 2006. So we think this is endogenous and it shouldn't be a problem. And the second point is on oil burden, which is still relatively low compared to history. It's currently for EMs at the levels that was in 2003, as well as oil burden, i.e. the oil consumption as a percentage of GDP in value.
But Chetan, my next follow-up question would be that the global commentators we speak to, and the general view at least from some of the equity strategists, is that US economy is now aging. The bull market has been a long and a tired bull market. The data points which you map, and you know, if I just take a leaf from our conversation, you're sounding rather bullish on the prospect of the US economy. The data points are moving higher. Growth is expanding. Yet the general view is that you know, US economy is going to top out, the markets are going to top out. Why is that?
So firstly, economies don't die of age. So we shouldn't get just bogged down by the number of years the expansion cycle has continued. I think we should just take it up more on a simple framework perspective, whether you are seeing the typical signs of overheating, i.e. you are seeing inflation running away too much above the central bank's goal. And on the other side, we watch is the financial stability, i.e. is there too much of excesses in the corporate or the household balance sheet, they are leveraging up at a very rapid pace, that you will actually have a problem eventually when the Fed lifts interest rates. So we think, yes, we need to be watchful of those overheating risks, but at this point of time, those risks seem to be such that we think will be manageable. And we expect the US economy to be in a decent shape right until end 2019. We do see some risks emerging in 2020, but in the next 18 months, we think the US economy will be able to hold up.
No, but you know, that would essentially mean that you would see a lot of interest for the dollar, and the dollar yield would improve with growth and rates expected to move up. Traditionally or historically, we've seen that that's bad news for emerging market currencies. We've already seen part of it play out. Is there more bad news to come? Is the dollar index likely to rise further?
So our house view is that the dollar has peaked out right now as we speak tactically, and even from a trend line perspective, we expect the dollar to continue to depreciate. And the argument behind that is that the Fed is going to hike, but in the context of the fact that we have this fiscal stimulus, we see this twin deficit problem weighing on the dollar. either you will see potential widening in current account deficit. This is something that we saw in 2003 to 6 again, where the Fed was hiking, but the hike of interest rates was not enough to keep its saving investment in balance. And current account deficit kept widening, which resulted into weakness of dollar. Our FX team expects something similar, and they expect the dollar to continue to weaken. So in that sense, if the Fed is hiking, but you don't have the dollar strength, that works out okay for emerging markets. A combination of rising US interest rates and the rise in dollar together will be a problem.
Chetan, yeah, I'll take the clock back and I'll talk about June 2017 when we met for the Morgan Stanley conference. The general view which we got at the conference was that India was on a cusp of a strong economic recovery. World will do okay. Now, if I talk about the current positioning, US growth has surprised us and Indian growth has been good and bad in patches. So let's say if you have to meet again next year, which I'm sure we would, what kind of world we would be staring at?
So I think the world will still be holding up. We will probably see some moderation, but we expect global growth to be above trend. So our key narrative on the global outlook is the cycle is maturing, but not ending. So I think that's the backdrop that you will still see in June 2018. As regards India is concerned, look, I mean, if you pick up, it's how you want to see it. The reality is growth data is extremely good in the last 4 to 6 months. Post August 2017, once we had the GST problems getting out of the way, economy has been steadily turning, and we have now seen strength in a lot of the data points. So you look at two-wheeler sales, you look at cars, you look at commercial vehicles, you look at credit growth, that is also beginning to pick up. You saw Hindustan Lever's volume growth, even 2-year CAGR was 7.5%. So we've seen a proper pickup in domestic demand now, because this is the first time since 2013 taper tantrum problems that India is seeing a simultaneous pickup in consumption and exports. So we were always of the view that you need this synchronous recovery in consumption and exports to get the capacity utilization up. Then only you will see corporate sector coming forward to do some capex. And we think we are now at that stage where capacity utilization is beginning to pick up. And so in 6 to 9 months' time, you should see a meaningful improvement in private investment too.
So you're bullish on the world, you're bullish on emerging markets, you're bullish on India. Suffice to say that?
Yeah, absolutely. But at the same time, I would say that since cost of capital is rising, see, when growth is strong, inflation is low, and liquidity is abundant, that's the great environment for risk assets. Now, to the extent to which you are seeing, inflation pick up, central banks are beginning to unwind, you will see some case for differentiation, because when cost of capital rises, you have to differentiate who really can withstand that higher cost of capital, which is why I was mentioning earlier that even in EM's context, it's not that all EMs are going to do fine. Some will face challenges in this rising interest rate environment.
Just to wrap it up, and historically we've argued that higher interest rate means stock prices will come down, it will have impact on demand. But we are coming off a low interest rate regime, and initially when interest rates they go higher, they can also add to pricing power, which was missing, I think, in 15 and 16 when commodity prices they came down. So should we look at the current uptick in interest rates more constructively?
Yeah, until the time inflation is not overshooting central bank's goal, that normalization of interest rates shouldn't necessarily bother the economy. I think EMs is a different story, but for the US, to the extent to which QE was an action which was in uncharted territory, now unwind is also something that is in uncharted territory, and there can be unintended consequences. So we'll have to watch. That is the risk that we could potentially see when this is happening.
I have to ask you a question on PSU banks, Indian PSU banks. I don't know how to frame my question. I just get speechless when I ask commentators to talk about Indian PSU banks.
So what is your specific question on PSU banks? What to do as an investor?
Actually, where are they headed? That's 65-70% of the market share of the total lending book. With the exception of 3, 4, 5 banks will not have the ability to lend. And even if economy comes back, I wonder who's going to really fuel the credit growth.
And if we are staring at a rising interest rate scenario, then either ways, that little corporate appetite which is expected to come back or bounce back, the private capex cycle, will get pushed back again.
So look, that is one major pushback that we always get when we talk about capex recovery in India. So it's a very valid question. But the way we approach it is that, look, capital markets today in India are bulk of the funder of macro. or capex. Banking sector is, if you just look at last 12 months, they have been funding about 30 to 35% of the incremental macro funding needs. So their importance as a source of macro funding has reduced over the years, and particularly so in the last few years when PSU banks have not been able to lend enough. So first of all, we don't think that it is a serious macro constraint right now when we have minimal capital needs, which is more related to brownfield expansion rather than big greenfield expansion. And second is that within the banking system, the public sector banks are now healing. We are seeing the change at the margin in terms of what the government is doing. But it was a legacy problem. It was a huge problem. So it is going to be a constraint in the near term. So I wouldn't give a clean sheet to that problem. But I think if you put it in the context that it is a smaller proportion of macro funding, we should be able to still see recovery going forward. And one other point to keep in mind in emerging markets context, once they are out of the adjustment phase, the factor that really drives growth without leverage is exports. Yeah. And now to the extent to which we finally have that global trade recovery, that is going to help improve capacity utilization. And even if you look at the rating agencies' data, it's the SME sector which is already showing a big improvement in the rating upgrades because the fact that exports is helping improve their capacity utilization and profitability.
So in your differentiated emerging market strategy, which emerging markets are you bullish on, which ones are you underweight?
I am not doing any rating of emerging markets from a market perspective,
no,
but from an economic standpoint,
debt levels, etc.
Yeah, economic standpoint, we are basically saying that you need to be careful about the countries which run large current account deficit, and then also have oil import dependence. Whereas, and on top of it, if they have low real interest rates, that's a very difficult starting point for them. And some of those countries are like Argentina. So, or for that matter, Turkey. And at the same time, if you have countries which are oil exporters, have adequate real interest rates, then those are the countries which will do better.
So just one last, closing comment on compulsions. And when I say compulsions, general elections, and historically we've seen that governments, they tend to do a fiscal compromise in the run-up to general election, whether it is on the agri fund, farm loan waiver, controlling fuel prices. So are we going through that period of compulsions for next 12 months for the Indian economy where it would be very difficult to talk about projections because a lot may change on ground which actually is not economically savvy?
So look, I think there are two aspects. The underlying economic cycle, that seems to be doing well. Now, how that economic cycle may be impacted by the government's actions on fiscal front, I think the way we address it is seeing whether this is going to impact the rural wage market or whether this is just going to be some increase in spending. Look, 2009-10 was a very different backdrop because at that time you had very strong rural wage growth and high fiscal spending. The combination of the two was deadly. Now, to the extent to which rural wages are very well behaved, we think that should give us the protection to not to have a big spike up in inflation because of government's policies, which they may do some redistributive policies before elections. But to the extent to which rural wages are fine, we think that the redistributive spending that the government will do will only have minimal upside risk to inflation.
All right then, Chetan, great speaking with you. Thanks very much. This is of course the first major voice that we've got from the Morgan Stanley Investor Conference. And Chetan is bullish. He's bullish on global growth and he believes same time next year he'll still have good news to share with us. For now, we'll take a very short break, but when we come back, we'll keep it with the Morgan Stanley Annual India Summit, 20th Annual India Summit. When we come back, get you some more prominent points. So take a break then.